Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Welcome to the deep dive. Our mission is to provide you, the institutional investor, with a structured and contextualized interpretation of critical research. Today, we are unpacking the comprehensive macro and asset allocation views for 2026 from KKR. This is all from their recent institutional report, the KKR 2026 Outlook, which was published in late 2025.
And this report is a very clear signal from their global macro team. The core message is that the global cycle is transitioning. We're moving out of late-stage optimism and into a period that, it just demands intense selectivity.
So we're moving away from that era where just holding market indices, what they call beta bets, was enough.
Exactly. The mandate for 2026 is what they're calling the alpha imperative. It's all about active risk management and, proprietary portfolio enhancement.
And they have this unifying concept for achieving that alpha, which KKR terms high grading. It sounds simple, but what does it practically mean for an allocator?
Well, it's much more than a slogan. High grading is really a proactive mandate to upgrade every single element of a portfolio. We're talking capital structures, covenant quality, asset quality, even counterparty risk.
So if the cycle is maturing, as they believe it is, the focus has to pivot.
It has to. It pivots to resilience, quality cash flow, and capital efficiency. It's really the moment to ruthlessly trim the fat that's been accumulated during the easy money years.
Okay, let's unpack this mandate and the conditions driving it. Before we dive in, we do have to state clearly that this discussion is for informational purposes only. It's based solely on KKR's research and is not investment advice or a recommendation.
So moving into their foundational framework, when it was fascinating is the backdrop. This is not a recessionary call. In fact, KKR signals continued favorable global economic momentum. They're even raising their GDP forecasts for 2026 in many regions.
Okay, so that presents a fundamental paradox right out of the gate. If growth expectations are actually improving, why the urgent call for a defensive posture? Why the high grading mandate now?
The urgency comes from two intertwined factors. First is pricing. KKR argues that much of the recent productivity miracle is now fully priced into public markets. They note that the 10-year forward CAGR implied by the S&P 500 is now near 16%.
Which is high, though not quite at .com level.
Right. It's below the 21% we saw back then, but it still reflects a lot of investor optimism.
Yeah.
And the second factor is the structural shift, the regime change, which means the cost of being wrong has gone up dramatically.
Explain that regime change again. That's the shift that makes the old rules of portfolio management less reliable, isn't it?
Exactly. We're grappling with structurally higher for longer interest rates, geopolitical friction, and crucially, a capital market that's becoming much more discriminating. Liquidity isn't boundless anymore. Credit is being allocated based on structural quality, not just cyclical optimism.
And that requires moving away from those broad market bets.
It does. You have to move towards strategies that emphasize structuring, operational improvement, active ownership. That's the definition of alpha in this new environment.
The most compelling point KKR makes on the timing of high grading is this. The cost to actually do it is exceptionally low right now. They're basically urging allocators to exploit this window of opportunity.
They are, and they provide some robust metrics to back that up. Look at global equity markets. The premium for high-quality global stocks tracked by the MSCI AC World Quality Index has fallen dramatically. It's hovering at just 17% over the broader world index.
Which is near multi-year lows. Investors just aren't paying up for quality.
They're not. And that low premium tells us the market has been, indiscriminate in bidding up lower quality assets.
And you see the same thing in credit.
Precisely. The same dynamic. The spread between AAA and BBB rated U.S. corporate credit is highly compressed, nearing those 2021 lows. This lack of differentiation means an allocator can effectively trade up and quality sell lower risk assets, buy senior structured assets without giving up much current yield. It's a remarkable pricing anomaly they're flagging.
Let's pivot to the macro forces driving this. The regime change is really anchored in persistent inflation, isn't it?
It is, and KKR provides a precise target here. They forecast U.S. core CPI is settling at a structural resting heart rate of 2.5%, even excluding tariffs. The 2026 headline CPI is forecasted higher at 3%, driven partly by the peak impact from tariffs.
And they're focused on the secondary effects, not just the direct hit on goods.
That's the important part. Tariffs don't just hit the price of a product. They eventually filter through to the cost of services, like healthcare, via input costs. This structural scarcity is what's maintaining that higher inflation.
So you have this inflation constraint on one side, but it's contrasted by this AI-driven productivity boom. KKR highlights a genuine efficiency gain here. Since the launch of ChatGPT, S&P 500 inflation-adjusted revenue per worker is up 5.5%. That's a huge jump.
It is the good news, yes, but it comes with a major caveat: the massive capital intensity required to fuel it. KKR's data shows U.S. hyperscalers are now dedicating an astonishing 60 to 70% of their operating cash flow to CapEx.
Wait, 70%?
70%. It's a staggering reinvestment rate.
So what's the implication there? What should allocators be thinking when they see that?
It implies a huge amount of front-loaded optimism and, a potential scrutiny risk down the line. Now, KKR does note that leverage levels aren't at telecom bubble levels yet, but the sheer scale of investment raises questions about capital efficiency and eventual returns on that capital.
Right. So the value might accrue less to the enablers and more to the efficient appliers of AI.
That's where the true alpha opportunity lies, in their view.
Okay, let's move to geopolitics. KKR calls the security of everything a maximum bullish macro theme.
And that theme is expanding fast. Security isn't just defense budgets anymore. KKR defines it as encompassing data sovereignty, energy independence, payments infrastructure, supply chain resilience, all of it.
So while military spending is up, the real theme is in that blurring of lines between economics and national security.
Exactly. Technology transfer, IP protection, semiconductors.
Mm-hmm.
These are now national security issues, and that's driving state-influenced CapEx into the real economy. This theme benefits physical assets.
But this expansion is still very uneven, which feeds directly into their analysis of K-shaped dynamics.
Yes, we continue to see that divergence everywhere. Services growth outpacing goods, large cap outpacing small cap. But the clearest split is the consumer. High-end consumers are financially robust. Their household wealth in the US, Europe, China, it's often higher than pre-pandemic levels.
But the lower end of that consumer base is really struggling with affordability.
Precisely. For that low to middle income group, essential costs, food, healthcare, electricity, are eating up a huge share of their income. You can't just bet on the average consumer anymore. You have to target essential defensive sectors or the high-end experience economy and avoid that discretionary middle.
That divergence leads us straight to the alpha imperative in private markets, where KKR urges allocators to make your own luck. What does that look like?
It's all about control. In private equity, they favor complexity and operational improvement over simple leverage. So that means corporate carve-outs where big companies shed non-core divisions and public-to-private deals that allow for restructuring away from public scrutiny.
And they're also pushing into capital light models.
A huge push, specifically into asset-based finance, or ABF. This is about financing pools of high-quality, collateral-backed cash flows, like supply chain receivables or equipment leases.
But hold on, if the economy's doing okay, like KKR says, why are they so worried about what they call credit vintage risk? It seems contradictory.
That's a crucial distinction. They're not signaling systemic risk. They're signaling structural risk that's built up in specific pockets. KKR warns that the 2021 and 2022 vintages saw vast amounts of credit extended with loose terms and high leverage, all assuming rates would stay low forever.
And now that assumption is broken.
It's broken. So they forecast defaults will rise toward the post-2011 average of 2.5%. This means those specific risky vintages are going to face very high severity losses as maturity walls approach.
So the recommendation is to high-grade your credit exposure now. What structure offers the best relative value in their eyes?
They strongly advocate moving up to private investment grade origination. This is senior, secured debt sourced directly from sponsors or companies. Crucially, it currently offers an attractive illiquidity premium, often 60 basis points, over the compressed spreads in the public IG market, and you get better downside protection through bespoke covenants.
And shifting internationally, they're looking away from expensive U.S. large caps.
Correct. Specifically toward markets with ongoing structural reform. Asia is the primary region here. It's a two-pronged opportunity. First, you have the structural reform narrative in Japan and Korea. Japan is compelling, with something like 40% of the market still trading below book value.
So lots of room for efficiency gains. And what's the second prong in Asia?
Consumption upgrades. KKR points to India and Southeast Asia. The narrative there is structural demographic demand, not cyclical recovery. And since most institutional allocators are pretty underweight that region, KKR sees it as a patient, attractive entry point.
Let's tie this back to portfolio construction. KKR is arguing that the traditional design playbook is essentially broken.
That's maybe the most disruptive thesis in the whole report. The long-standing negative stock-bond correlation, the very foundation of the 60/40 portfolio, has broken down. Bonds are just not the reliable risk-off hedge they once were because of the higher, more volatile inflation regime.
So portfolios have to be constructed differently.
They do. They need to benefit from three sources: genuine manager alpha, non-correlated assets, and upfront yield. They point out the return differential between the best and worst assets is tightening, which just screams selectivity.
This requires some specific investment tilts. Let's zero in on, say, 3 of the most actionable themes that align with that high grading mandate.
Okay. First would be the corporate reform tilt. Shifting from capital heavy to capital light. This means targeting those carve-outs we mentioned, or investing in capital-efficient solutions like asset-based finance, especially securitized receivables.
Second, they highlight productivity and worker retraining. Why is this a private market opportunity?
It's a policy gap opportunity. The U.S. government, for example, invests less in worker training as a percentage of GDP than almost any other OECD country. That neglect creates a massive private sector opportunity in platforms for labor market analytics, skills training, and automation tools that help workforces adapt to AI.
And the third theme is owning collateral-based cash flows. This links directly to the higher nominal GDP forecast, doesn't it?
It's a direct response to that regime change. If cash flows are tied to hard collateral or nominal prices, they outperform in a higher inflation world. This strongly favors infrastructure, energy assets, and, again, asset-based finance. These assets provide that critical yield and resiliency.
Given this selective environment, KKR also provides a clear list of things to avoid.
Yes. The top avoid is overly levered capital structures, especially from the 2021 vintage. This includes a lot of debt-funded roll-up strategies in software and healthcare. Second, they caution against long-duration treasuries. They're just not a reliable safe haven anymore. And third, they warn on certain sectors, namely consumer staples, which they see facing margin compression and losing pricing power.
Let's look at their risk framework. They say traditional risk signals, frothy IPO markets, high household leverage look pretty benign. So where's the real risk?
The risk is entirely lodged in the non-traditional dynamics of the regime change. It's the persistence of inflation, the geopolitical blurring of lines, the severe K-shaped divergence. These are novel risks that require active management.
And before we close, what's their view on oil prices for 2026?
They're cautious in the immediate term. KKR is forecasting WTI around $60 a barrel. They cite near-term oversupply from non-OPEC sources and slowing demand growth. However, their longer-term view is more constructive. They see a recovery to the $65 to $70 range by 2027-28.
And the U.S. dollar. They admit it's structurally overvalued.
They do. They estimate it's about 15% above its real effective exchange rate. But they only expect a slow, gradual unwind, not a sharp crash. They believe robust FDI flows and strong portfolio flows provide a significant offset that prevents a collapse.
Finally, let's use China as a case study for structural risk, specifically the deflation trap they outline.
China's challenge is structural labor absorption. KKR projects automation could displace 90 to 100 million manufacturing jobs by 2035. To absorb that labor, their service sector has to expand by 6% or more every year. That's a monumental task given low consumer confidence. KKR sees painful policy pivots as essential to escape that trap.
So to synthesize KKR's core message, 2026 is a transition period, not an endpoint. Returns will be found through active management. The mandate is clear: high-grade your portfolio now while the pricing of quality is still relatively cheap.
And we'll reiterate that this deep dive was based exclusively on the KKR 2026 Outlook report. It's provided for informational purposes only and is not investment advice.
And here is a final provocative thought for you to explore in your own due diligence. KKR pointed out a striking structural divergence. Leading Chinese tech firms are running capex to revenue ratios in the 8 to 10% range, prioritizing capital efficiency. In stark contrast, U.S. hyperscalers are at 16% and rising, relying on massive capital intensity. So the question you have to ask yourself is this: what are the long-term implications if China can generate comparable or even superior AI productivity gains through capital efficiency, while the U.S. model relies on ever-increasing capital spend? That is a divergence worth monitoring very, very closely.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.